In these times of war and high volatility on the market, it could be very interesting to find many ways to generate some passive income. In this video, you will find out what are the best Canadian ETFs to generate some monthly passive income as much as you have ever dreamed. Hey, how's it going, guys? And welcome to the North Investor, where we're all about personal finance on our path to financial freedom. To present to you what are my top 4 Canadian dividend ETFs, I've based my decision on many different criteria. The 2 main criteria that I've based my decision for these kind of ETFs. First, of course, is the diversification that the ETF offers considering the current crisis in Ukraine, but also what is the dividend offers by the ETF. And so in this video, you will find only some Canadian ETFs, but in those ETFs, I have decided to include some Canadian ETFs that have some exposure, for example, to the US market. So now let's go to my pick number 1. The first ETF is the iShares ETF from BlackRock, tracking the S&P TSX Composite High Dividend Index. I first decided to choose this ETF since it is managed by BlackRock, which is the world's largest asset manager in the world with more than $10 trillion in asset under management. This ETF is super interesting since it pays some monthly dividend income. It also has some super low cost with only about 0.22% of MER. And it also is focused on long-term holding, tracking the S&P TSX High Dividend Index. Since it is a tracker of a high dividend index, we can see that its main holdings are focused into the dividend aristocrat stocks in Canada, which are mainly focused in the energy, the financials, and the communication sector with companies like Suncor, Enbridge, RBC, and TELUS. And this is pretty well reflected in the exposure breakdowns, which include sectors like energy, financials, communication, but also the utilities, which are the top 4 biggest dividend aristocrat sectors in Canada. This is one of the main ETF of BlackRock with about $1.7 trillion of net assets. The rebalancing of the fund is made quarterly, and it has about 76 different holdings in this fund. As I told you earlier, the distribution is made monthly with a distribution yield of about 3.63%. And finally, for the performance of this fund, we can see that it has been tracking pretty well the index with only a slight difference, which is pretty normal since there is no ETF in the world that can perfectly track an index. It has clearly done a great job during the past 10 years, as we can see over here, with about 8% of return on average on 10 years. And we can see it here that if you started 10 years ago with $10,000, today you would be worth about a little bit more than $22,000. For my second pick, I've decided to plunge into the US market and go with an ETF that tracks the top US dividend stocks, which is the ETF BMO USI Dividend Covered Call ETF with the ticker ZWH. What is really interesting about this kind of fund is the fact that it gives you some exposure to the US market onto the high dividend US companies, which are evaluated with a rules-based methodology that consider the dividend growth rate, the yield payout ratio, and the liquidity. But also one of the reasons why I think that this ETF is really great is the fact that it gives you some protection on the volatility side. So this protection is offered by some call covered option that has the impact to reduce the volatility by giving you a certain limited downside protection. And this is really important considering the current situation where the market and the volatility itself is super high at the moment. But this fund also gives you some diversification from the US currency. And this ETF also have a super small MER of about 0.72%, which is slightly higher than what we've seen with my pick number 1. And the total value of this fund in November last year was about $1 billion. And this fund also have a distribution yield of about 5.75%. Looking at the asset allocation of this ETF, it is super interesting to watch for the portfolio allocation, the top 4, where there are 2 of the 4 stocks that were not there in my previous pick on the Canadian ETF with some Canadian exposure. First, as you guys can see, there is about the quarter of the total portfolio that is in tech. So you guys probably know that in the US there are many great tech companies just like Apple, Microsoft, etc. And Apple is currently the pick number 1 in the investment, and Microsoft it is their 7th pick with about 4%. And the other sector that was not there in the first pick that I've presented to you is the healthcare with about 13.7% of ponderation. And it's really interesting since in Canada we don't have private companies, since the healthcare is all public here, which means that we don't have any kind of dividend stocks to invest in that sector. And so if you invest in the US in that kind of ETF, it is interesting to have companies just like Johnson & Johnson. But here we can see that their second pick is actually Pfizer with about 4.2% of ponderation. And so we see that the financial with about 14% of ponderation and the consumer discretionary are two picks that were previously in my first ETF that I did present to you. For my third pick, we come back to the Canadian market with the Vanguard Canadian High Dividend Yield Index, which once again, just like my first pick, track the High Dividend Yield Index in Canada. As I told you, this fund is a tracker, which means that its MER is super low, about 0.21%, which represent 0.01% less than the BlackRock ETF I've presented to you earlier. However, the 12-month yield, which represents the distribution yield of the fund, is a little bit smaller as well than the BlackRock one, about 3.46% that is distributed monthly. This ETF has about 39 stocks, which are mainly focused on large cap companies. As you've been able to see by the name, all this ETF is located in Canadian investment. And as we've been able to see with the BlackRock ETFs, all the different Canadian dividend aristocrats are located in the financials, the energy, the telecom, and the utilities sector. The Vanguard holdings will be pretty similar to the iShares holding, as we can see here, but the ponderation might be different, of course. And we see here that its main pick is RBC, but also we see that Enbridge is coming back. We also have TC and Bell that are coming back as well from the iShares ETF. Something super interesting to see is the difference of return on 10 years chart of this fund compared to the BlackRock funds. And for the BlackRock funds, after 10 years with $10,000, you would be at approximately at $22,000, and with this fund we see that we are about $26,000, or $4,000 difference, which is huge. And this is a lot explained by the fact that after the big drop of the pandemic, we've seen that this ETF has been resisting pretty well compared to the BlackRock one. For my last pick, I've decided to present to you a bonus pick, which is an ETF that is not known by many, but since we are on the Canadian market, I wanted to share with you an ETF that is on the financial side, and that's why I've decided to present you the BMO Equal Weight Banks Index ETF with the ticker ZEB. This kind of ETF would be a great way to replicate the return of the big 5 banks in Canada. Indeed, it is tracking the performance of the Solactive Equal Weight Canada Banks Index, which is the index in Canada that tracks the biggest bank here. And personally, I think that it could be a great ETF to look for in 2022, knowing that the interest rates will increase in the months to come. Since this ETF is another tracker, its MER is super low as well, only 0.28% of fees. And this ETF also will give you an equal weight exposure to the 6 major Canadian bank equities. And if we look at the annualized performance on 10 years, we can see that it was quite good, about 13% of return on average on 10 years. And this is also knowing the fact that those kind of companies are super not risky, and it could be a great way for people to receive some passive income, but also some growth potential. And so the asset allocation is quite simple. You have the 6 big Canadian banks, which are equally split into this ETF. So as you can see, they are already focusing on the big 5 banks, and they are not trying necessarily to add some smaller banks because they consider that the big 5 banks are safe enough and are giving some great return, and that they don't need to take too much risk with this ETF. As you've been able to see in this video, most of the Canadian dividend ETFs are focusing on the main dividend stocks. Of course, this is due to the fact that the main Canadian dividend aristocrat stocks are focused in the financial sector, but also on the energy sector. This is why we are seeing such high exposure in those ETFs to stocks like the 5 big banks, but also companies like Enbridge or Pembina. Personally, I prefer to hold those dividend stocks in my TFSA, for example, to earn the dividend by myself and not buying those ETFs, but this is only my personal preference. To see what are the best Canadian dividend stocks that you should buy in your TFSA, check out my latest video on this subject that is going to be just right over here. And obviously for everyone that is new, I invite you to join the Nord family by subscribing to the channel for only $0.0 and let me know in the comment section what are your favorite dividend stocks, and I will see you soon. Peace.